Hey everyone, welcome back to the Deep Dive. Today we are tearing into Ball Corporation's second quarter 2025 earnings call. It was just on August 5th. Our mission, as always, is to boil down all that critical information from the call, give you the absolute essentials on their performance, their outlook.
Yeah.
Without you having to wade through hours of corporate speak. Because who has time for that, right?
Right. And Ball certainly delivered what looks like a pretty strong headline beat for Q2. Their comparable EPS, it came in at 0.90 cents. That actually beat the $1.87 consensus by 3.4%. And revenue also topped expectations, $3.34 billion. The street was looking for more like $3.12 billion. That's a solid 12.8% year-over-year increase. Pretty significant. And global aluminum package shipments, they saw decent growth too, 4.1% year-over-year.
Absolutely. Those are, undeniably positive numbers on the surface, that revenue jump especially.
Yeah.
But here's where it gets interesting, and what we saw play out live on the call. Despite these strong top-line figures, the market, wasn't exactly thrilled. We saw an immediate negative reaction to the share price as the call went on. The focus just shifted, really quickly beyond those headline numbers. Almost like the market sniffed something out.
Yeah, it definitely did. And the conversation turned pretty fast to the underlying segments, specifically North America.
Okay, let's unpack this then. Let's dive deeper into the financials, the management commentary, the guidance, everything that shaped that post-call reaction. Because, comparable EPS and revenue look good, but the GAAP EPS told maybe a slightly different story. It was $0.76 for the quarter. Now, that is up significantly, like 49 cents year over year, but it also reflects some, one-off items, adjustments. It's different from that comparable number the market focuses on. And crucially, when you break down this segment operating earnings, this is where you start to see maybe some of the market's unease. North and Central America, $208 million. EMEA, $129 million. South America, $51 million. A bit mixed, wouldn't you say?
Definitely mixed. And it just shows how even strong headline beats can have, nuances under the surface. Something else notable, though, the commitment to returning capital. They've been really active there. It turned $1.13 billion year to date, buybacks and dividends. That's a pretty clear signal of confidence, I think, in their financial strength and cash flow.
And speaking of confidence, they reiterated expectations for record free cash flow this year.
Yeah.
For fiscal 25, that's a big deal for them. Sort of signals an inflection point financially.
Right.
So even as the market was maybe getting hung up on segment details, the underlying financial discipline seems solid.
That's right. And moving to what management actually said, their themes and guidance. CEO Dan Fisher, he highlighted that robust financial position, which, like you said, let them actually raise their full-year comparable EPS growth target. They bumped it up to 12-15%. It was 11-14% before. That's not just a small tweak, it shows real conviction.
So what themes were they hitting hard to back that up? What was the story?
The key themes were pretty consistent. Disciplined cost control, that was big. Continued strength and demand for sustainable cans. That's obviously a huge tailwind for them. And having a leaner footprint now that the aerospace business is gone, that last point's important. It really completes their pivot. They're all in on packaging now.
Makes sense. Focus can mean efficiency and their plans for returning capital for the full year.
They expect to return at least $1.5 billion total for fiscal 25. And strategically, there were a few updates pointing to this leaner, more focused approach too, like closing that Florida can manufacturing acquisition back in February, adding capacity where they need it, deconsolidating the aluminum cups joint venture in March, simplifying things. And they're planning to sell a 41% stake in their UA can this quarter in Q3. That should bring in about an $85 million gain. So it's not just random selling. It feels like strategic optimization.
What's really fascinating here, and what, like you said, grabbed the market's attention, was that North America segment. You said margins slipped, even though volume was stronger than expected. Can you break down why that happened? What was the explanation?
Absolutely. So North America volume grew, especially energy drinks. They were up nearly 20%, which is huge. Sure. But margins went down. Management pointed to two main things. First, an unfavorable product mix, basically selling less higher margin beer and more lower margin non-alcoholic stuff. Second, some operational inefficiencies because certain categories grew so fast, unexpectedly fast, they just weren't totally ready for that sudden surge, and it, strained things a bit.
Huh. So it wasn't a lack of demand, it was almost too much demand in some spots, hitting at the wrong time, combined with a less profitable mix. That is tricky. What about tariffs? Were they playing a role too?
Yeah, tariffs got to mention. They were cited as a drag. Estimated impact was about $2-3 million out of a roughly $10 million total hit to profitability in the segment. And they made a point of saying this wasn't due to contractual pricing changes, just the cost of imports hitting the bottom line.
Okay, so capacity is coming online, which should help, but those tariffs are still a bit of a headache. Is that the story everywhere, or are things different in, say, Europe or South America?
That's a great question, because the picture is different elsewhere. Europe, for instance, continues to look really robust, mid-single-digit volume growth there, sustained operational leverage, high margins. It's kind of the standout region right now. They're adding capacity there and might even need more if things keep going like this. South America, well, Brazil was a bit below what they initially expected, but they saw strong volume in Argentina and Chile, which helped boost the segment's comparable operating earnings by 38% overall. And they expect Brazil to get back to growth in the second half. So some optimism there, too.
Right, so quite a varied regional performance then. What about bigger picture stuff? Macro themes, consumer behavior, inflation. How's that feeding into can demand?
Yeah, on the macro side, management basically said customers need cans for volume growth, especially now when consumers are feeling price sensitive. They use the phrase consumers are strapped, which is pushing demand for multi-packs, for at-home consumption. They acknowledge Ball is recession resistant, but maybe not totally inflation resistant, because if consumers get too price sensitive, it can hurt volume. But yeah, they are benefiting from those at-home trends, the multi-pack buying. That plays right into their wheelhouse. Oh, and interestingly, they said scrap metal pricing had a negligible impact on profit because of how their contracts are structured.
That's smart, hedging that commodity risk.
Exactly. For a lot of manufacturers, that volatility is a killer, but Ball seems insulated there.
And speaking of strategy, you mentioned the pivot away from aerospace. Are they doing a similar kind of repositioning within the core packaging business itself?
Absolutely, yeah. They're intentionally shifting the portfolio mix. The aim is to go from about 40% alcohol beverage exposure down to maybe an optimal 30% over time. Really focus on those categories with stronger growth tailwinds, like we saw with energy drinks. That's a conscious strategic shift.
Which reflects broader industry trends too, right? Consumer tastes are changing.
For sure. And they've also locked in a lot of future business, high levels of contracted volumes. Over 90% for North America in 2026, about 75% for 2027. That gives them a lot of stability, a lot of predictability. And finally, they talked up their Ball business system, basically their internal efficiency program. Said it's driving manufacturing improvements, helping offset some supply chain issues and those tariff impacts, which is partly how they can maintain and even raise that EPS guidance despite the headwinds. Safety and quality metrics are apparently world-class.
Okay, so pulling it all together, what does this mean for you, the listener, maybe as an investor? This Q2 call really highlighted a clear split, didn't it? You had management emphasizing cost control, strong underlying volume, big capital returns, leading them to raise guidance. Very positive story from them.
Right.
But the market, it just zeroed in on that North American margin pressure.
Right.
And the stock price reacted immediately, despite the headline beat. It's a classic case of what the market decides matters most. And for Ball, North America isn't just any segment, it's the core.
Yes, exactly. Any weakness there, especially if it looks like it might persist, tends to overshadow good news elsewhere in investors' minds. And connecting it to the bigger picture, Ball is going through this major post-aerospace transformation. They're using that much stronger balance sheet net debt leverage below 2x EBITDA now that's really healthy. Gives them flexibility. Flexibility for moves like the Florida buy, the UAE sale. And innovation is key, too. Lightweight cans, high recycled content. That's crucial for their growth flywheel, especially in ESG-focused markets. Sustainability is huge.
So what are the key things to watch for then in the near term? What are the catalysts or checkpoints?
Okay, near term, definitely watch for the closing of that UAE stake sale in Q3. That brings in cash, about $85 million gain. Q3 results coming in early November probably will be absolutely critical. Everyone will be looking for signs of North America margin stabilization. That's the big one. Also, any updates on those aluminum tariffs and confirmation they hit that $1.5 billion capital return target for the year. Longer term, the story is all about Ball becoming this pure play, super efficient aluminum packaging leader. Success really hinges on keeping volume growth going while getting those North American margins back up. It's a balancing act.
A tough balancing act. Growth versus margin. Okay, let's shift gears. Time for our This Is Not Financial Advice segment. Let's hear an outrageous but maybe plausible trade idea based on all this.
Okay, all right. So Given how the market reacted, focusing so heavily on that North America margin dip, which management says is mostly temporary mix shift and, growing pains from unexpected demand, we propose a strategic pair trade. It's a bit punchy, but here it is. Go long Vault Corporation and short a major legacy domestic brewer, one that really relies heavily on that North American beer market.
Okay, interesting. Long ball, short big beer. Walk us through the thinking there. What's the rationale?
Well, the rationale is kind of multi-layered. First, Ball is actively, intentionally pivoting away from beer towards higher growth stuff like energy drinks. We saw the numbers there. So even with the current margin pressure, they seem confident they can manage costs, benefit from this mix shift over time, especially as new capacity comes online. And remember, those high contracted volumes give them stability. Meanwhile, you've got consumers who are strapped, favoring multi-packs at home. Ball's packaging is pretty defensive in that environment. Contrast that with traditional brewers potentially facing declining beer consumption trends, plus maybe their own tariff issues. So the trade basically leverages Ball's strategic repositioning and efficiency focus against the headwinds hitting more traditional beverage categories.
Got it. So you're playing Ball's pivot against the potential struggles of the category they're pivoting away from. Okay, so there you have it. Ball Corporation. Strong Q2 headline beat, yes, but the market zoomed right in on those North American margin pressures. The company's actively managing its shift, adding capacity, returning cash, making moves, but clearly the market is watching that margin line like a hawk.
Yeah, the core challenge really is stabilizing margins in their biggest market, North America, while still capitalizing on that global demand for sustainable aluminum packaging. It's a fascinating story to watch unfold, that balancing act.
Definitely. And remember, everyone, this analysis is purely for informational purposes. It is absolutely not financial advice. We really encourage you to dig into the details yourself, do your own homework, and form your own conclusions. Always more to learn.
Absolutely. And we appreciate you tuning into the deep dive. Join us next time for another deep dive into the numbers that are moving the markets.